Hello and welcome to this session in which we will discuss contribution of non-cash asset to a charity. Now remember, non-cash means something other than money. Why is that relevant? It's relevant because it depends on what type of asset you are contributing, the type of the asset, whether it's short-term, long-term, whether the charity going to use the asset for themselves or sell it. And it makes a difference whether it's a vehicle or a non-vehicle asset. So that's what we need to learn about, because in tax planning, you have to be careful in how to contribute and what to contribute and how much to contribute in order to do what? Maximize your deduction, which means what? Reduce your taxable income. And this is what we will discuss in this session. Starting with a qualified charity. What is a qualified charity? Well, a qualified charity is a charity that's recognized by the IRS as Section 501c organization. And this category includes both public charities that receive funds from the general public, like the American Red Cross, religious entities like churches, synagogue, temple, mosques, any religious entities, the Salvation Army, private foundations. Those are funded by individuals, a family, or a corporation. Those are like the Ford Foundation and Bill and Melinda Gates Foundation, among others. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Now, what happens if you donate ordinary income property? So you're giving ordinary income property. First of all, what are ordinary income property? Inventory. So if you have inventory in your store and you donated this inventory. Assets held for less than a year, short-term assets. Investment or personal use asset that have decreased in value. So you have this personal use asset, but it decreased in value. It's decreased in value. It means less than the cost. You have a loss on it. Long-term investment asset use where depreciation has been reclaimed, which you have depreciation recapture. So when you have depreciation recapture, it's considered ordinary income property. So if it's an ordinary income property, now if you don't know what depreciation recapture, I'm going to cover briefly an example, but you should know what depreciation recapture is, but don't worry, we'll work a brief example illustrating this concept. So for these type of donations, ordinary income property, what's going to happen is this. You're going to take the lesser of, you're going to look at the two values. The property adjusted basis, this is typically the cost of the property, adjusted by depreciation if that asset was depreciated, the lesser of that amount, or the fair market value at the time of the donation. What's the fair market value? How much you can sell this asset for. So if you are contributing a piece of inventory and you paid for it $800, when you are donating this inventory, it's worth $500. Which of these two you will take? You will take the $500. If you are donating this inventory, you paid for it $800, but it's worth $1,200. Which one will you take as a deduction? $800. So any of these ordinary income property, you will take the lesser of cost or fair market value. Let's say adjusted basis to be technical. How about if you contribute long-term capital gain property? So what is long-term capital gain property? Well, you held it for more than a year. When you donate long-term capital gain property to a charity, the tax deduction you can claim is based on the property fair market value. So you bought those assets and you hold them for more than a year, or that building, that piece of equipment, whatever you have and you held for more than a year, you can take the what? Fair market value. So if the fair market value went up, you have a decent deduction to take. Long-term capital gain property refer to the asset that increased in value that you have held for more than a year. And this could include investment asset like stocks, bonds, real estate that you have invested in, which appreciated over time. It could include personal use asset like art, jewelry, a car, that what? That went up in value. What happened if it went down in value? It's considered ordinary income. Or gain in excess of ordinary income depreciation recapture. Well, this applies to long-term business asset use. What does that mean? It refers to the portion of the asset increase in value that exceeds the amount of depreciation you have claimed for tax purposes. Let's illustrate gain in excess of ordinary income depreciation recapture. Let's assume you purchase an asset for $100,000. You took depreciation $60,000 over the years. You sold the asset for $120, or the fair market value of $120. It means you can sell it for $120. So what's the total gain? The total gain, if you look at the selling price minus the purchase price, equal to $20,000. Now, what's going to happen is this. From a tax perspective, the entire gain is equal to the depreciation claimed. What happened is this. Yes, indeed, you have $20,000 of gain, but over the years, you took $60,000 in depreciation. So what's going to happen, we're going to say, since you took this $60,000 as deduction against ordinary income, you would have to recapture this gain because the gain is $20,000, but you already took advantage of $60,000 of this asset. Therefore, it's all treated as depreciation recapture. So, since the gain does not exceed the total depreciation, there is no gain in excess of ordinary income in this scenario. So, in this example, the entire gain is considered depreciation recapture and is taxed as ordinary income. So, when would it exceed? Well, if you sold it for $200,000 minus $100,000, that's equal to $100,000 in gain. Well, of that gain, $60,000 you have to recapture as depreciation, and the $40,000 will be gain in excess of ordinary income depreciation recapture. So I want to make sure you understand this. And depreciation recapture, it's something you have to be familiar with as a CPA exam candidate. How about tangible personal property asset put to unrelated use? What does that mean? When you donate a tangible asset like artwork, furniture, equipment, a piano to a charity, and the charity uses it for a purpose unrelated to its mission, like selling it, the tax deduction you can claim is limited. In such cases, your deduction is not based on the item fair market value. Instead, it's on the item's adjusted basis, which is usually what you paid for it, adjusted for factors like depreciation and improvement. Simply put, if you donate a physical item, tangible item, to a charity, and the charity does not use it for its charitable work, whatever that charitable work happens to be, your tax deduction is limited to the original cost of the item minus any depreciation, not the fair value. Let's take a look at an example. Let's assume Emma purchased a vintage grand piano. This is the piano. That's what I was telling you about. For her personal use at a price of $40,000. 10 years later, a local community center, which is registered as 501c charity, shows interest in the piano for use in its music program. So Emma, what she did, she appraised this. She brought an appraiser to tell me how much the value of this. If the amount of this piano is $35,000, well, the piano value has decreased from $40,000 to $35,000. There's a decrease. Since it's a capital asset held for more than a year, it's considered what? Ordinary income property. Therefore, how much she would take? She would take the lower of basis or fair market value, which is the lower is $35,000. Let's assume the fair market value is $45,000. Well, the piano has increased from $40,000 to $45,000, classifying it as long-term capital gain property. Under those circumstances, she can take the fair market value, which is $45,000. Therefore, their total contribution is $45,000. Now, bear in mind, if the charity decided to sell this piano, remember, this charity, the goal of the charity is to use it in their music program. This is scenario 1 and scenario 2. If they sell it, she's limited to $40,000 to her basis. How about when someone donates a qualified vehicle and that vehicle is sold by the charitable organization? When you donate a vehicle like a car, truck, boat, airplane, anything that move for personal use to a charity, and the charity then sells it, the rules for your tax deduction are a little bit different. And it all depends on how much they sold this vehicle. So how does it work? If the vehicle fair value is over $500, we have a sets of rules. If it's less than $500, we have a different sets of rules. Let's assume it's more than $500 at the time of the donation. Your donation is limited to the lesser of the two amounts: the gross proceeds the charity received from the sale of the vehicle, or the fair value on the date that you donated this asset. So let's assume you donated this asset when the fair value of it was $900. That's what you donated. But when they sold it for $1,200. Guess what? They're going to take the $900. Because when you donated it, that's how much you donated it for. Maybe they added something to it, they cleaned it, they make it more presentable. You cannot take this additional $300 deduction. So this rule applies assuming the fair value is less than what originally paid. So we're assuming this is a loss. So this car, this truck, you're donating it at a loss. That's what we're assuming here. Let's assume if a charity sells the vehicle for less than $500, for $500 or less, your deduction is limited to the lesser of $500. You cannot be more than $500, or the vehicle fair market value at the date of the donation. Again, under this assumption, the fair market value is less than the adjusted basis of the vehicle in those scenarios. Let's look at an illustration. Let's look at this illustration to explain the concept with numbers. Let's assume you own an old car, or maybe a boat, a bike, it doesn't matter, some sort of a vehicle that you don't need anymore. You decide to donate this to the charity, which then they sell it. How much can you deduct from your taxes for this donation? Well, it depends on a couple things. And we're assuming here that you're donating this and it's less than its cost. Usually a car, a boat, after you use them, they're less. If your vehicle is worth more than $500 when you donate it, let's say the car is still in pretty decent shape and its fair market value is more than $500 when you gave it away. So it's more than $500. Your tax deduction is limited to the smaller amount of what the charity sold it for. Let's imagine the charity sold it for $800, but when you gave it to them, it was $750. How much can you take? $750, because maybe again, they made it look better. That's not that you cannot take a deduction for that. Remember, this is only when the fair market value of that car originally is less than its cost, than its original cost. Let's assume if the charity sold this vehicle for $500 or less. Now, suppose the charity end up selling the vehicle for something like $400, which is less than $500. In this case, your tax deduction is the smaller of $500 or the fair market value when you donated. If the fair market value was $450, then they would allow you to take the $450. So simply put, they sold it for $400, but when you donated to them, when you gave it to them, it was worth $450. Since it's less than $500, I don't know, they waited too long. For some reason, they could not get $450, but you gave it to them, it was worth $450. They could not get $450. You can get the $450. But your deduction cannot be more than how much? $500. Again, we're assuming here you're selling an asset that is at a loss. Let's summarize strategies for donating non-cash asset. If you're donating a long-term capital gain property, what should you do? What's a long-term capital gain property? You held it for more than a year and it increased in value. The deduction can be claimed based on the fair market value. This is good. It's better than selling it, because if you sell it, you're going to be taxed on the gain. Although you're going to be taxed at a preferential rate, it's still better to donate because the value will be better in terms of deduction. How about donating long-term loss property? If it's a loss, if the property has decreased in value, the deduction is limited to the fair value or the basis, essentially what you paid for it. Selling the property first, then donating the cash would allow you to claim a loss on your tax return, leading to a better tax saving. So if it's a loss, sell it first. If it's a gain, donate. Why you can donate? It's long term. You can take the fair market value. Here you can deduct the loss. If it's a short-term capital gain or ordinary income, that would result in a short-term capital gain or ordinary income like inventory. Selling it first is better. Same thing. It will yield more because it incurs a capital loss, and you can deduct up to $3,000 against ordinary income or against other capital gains. So make sure you keep those strategies in mind when you're dealing with non-cash contribution to a qualified charity. Let's take a look at this multiple choice questions from farhatlectures.com. Which of the following assets would not be considered long-term capital gain property when donated? Which one will not? Will not. So 3 will. Stocks held for 2 years that have appreciated in value. Well, it's held for 2 years. Well, this is long term, so it's not. A is out. A painting held for, don't worry, I'm going to make a mistake here on purpose, come back and fix it. A painting held for 3 years that has depreciated in value. Well, it's a 3 years. It must be long term. Cross it. A car used for personal purpose held for 5 years that has appreciated in value. That's not really possible, but let's assume you held the car for 5 years and appreciated in value. It's 5 years, out. Real estate held for 18 months that increase in value, more than a year. So hold on a second. They are all for more than a year, So which one is not considered long term? You have to be careful. If you have a personal asset and has depreciated in value, it does not matter for donating for donative purposes. A painting held for 3 years had depreciated in value. Be careful. This is not long-term capital gain for as far as donated asset. Now be careful. C would have been tricky. A car used for personal use, you would say, personal use for 5 years that has appreciated in value. Because it appreciated in value, it's long term. If it depreciated, we'll have 2 answers, but we're not going to have 2 answers. So B is the answer. Be careful. What should you do now? You want to go to Farhat lectures, look at additional MCQs. That's going to help you do what? Understand these concepts better. Invest in yourself, whether you are studying for the CPA exam or studying as an accounting student. Good luck, study hard, and of course, stay safe.